You guys, today's video is a must watch. Come on in and join us. I'm going to be bringing on a special guest, mortgage expert Jason Gill, and he's going to demystify the mortgage process, tell you what you didn't know that you need to know, and lay out a clear path to homeownership success. Jason Gill is the founder of SoCal Purchase Loans, a company that prides itself on guiding customers through their home buying journey with education, building confidence, and achieving success. His approach is based on a strong belief that the more someone is educated on a particular subject, the more confident they are, the more successful they will be. You guys, Jason and I have been partners for over a decade, helping countless individuals and families purchase their first homes. He's not just a colleague to me, he's an incredible team player whose expertise has been crucial in making home ownership dreams a reality for so many. Today, he's here to share his wealth of knowledge with you. Without further ado, please join me in welcoming Jason Gill.
Hey, Michelle, how are you doing?
Good, how are you?
Good. That was a heck of an intro. I appreciate it.
You're welcome. Very well deserved. So thank you so much for being here. So let's dive on right in because we do have a lot of questions and these are popular questions that most people are asking. And again, questions that sometimes some people don't know that they need to know.
Sure.
So the first one is, what's one thing about the home buying process that surprises most first-time home buyers?
I think a lot of times if they don't initially maybe approach the situation the right way, I think understanding the market that they're purchasing in. I finance in different markets across the country. Obviously, most of it's Southern California, but to see the difference in what's going on in different markets versus, Texas versus Florida versus Southern California. And what I really mean by that is housing. We've seen since interest rates have climbed in 2022.
Yeah.
Right. That ultimately, why have the prices not gone down since interest rates have gone up? And that's because housing inventory controls price ultimately. And, in those other markets that I mentioned across the country, the housing inventory is climbing, and that's starting to have an impact on, on price in some areas. But in Southern California, with the housing inventory being so limited, it still is a challenge for buyers. So I think when you say, what do they not realize? It's that, hey, look, even with rates being higher in many price points, especially for a first-time home buyer in a starting price point, it can still be challenging. There's still competition, even with the higher rates. So I think knowing the market you're purchasing in, understanding that, obviously have someone like yourself educate them on what's going on,
right,
really helps approach the situation and have a better experience.
Most definitely. And that's super key because different markets and different areas that you're purchasing in are going to be different because some are going to be more popular than others. And so kind of knowing your footing and how to write that offer, right? And so that's going to be super important. So I love that. What factors should buyers consider when deciding between a fixed rate and an adjustable rate mortgage?
Yeah. So, in the past, when interest rates have climbed, or more specifically, when the fixed rates have climbed, 30-year fixed rates, let's say, as an example, it's been, typically we've gone and we've kind of adjusted with the market and we've offered borrowers adjustable rate mortgages. So to clarify, an adjustable rate mortgage doesn't mean that the interest rate is adjustable the entire time. Typically, for example, if you hear, oh, there's a 7-year ARM, it means that the interest rate is fixed for 7 years. And then after the initial 7 years, the interest rate would go adjustable. So it worked out perfect in the past. Obviously, we used an adjustable rate mortgage. It allowed the borrower to save a little bit on the interest rate. Typically, the difference between, in a normal market, the difference between a 7-year ARM and a 30-year fixed rate is about 0.5%, somewhere in that range. So,
Okay.
of course, it made sense. If rates are in the past, if the 30-year fixed rate was 4.5% and you could get 3.99% on a 7-year ARM, you would do that. And then a couple years into the ARM, typically later on down the road, the fixed interest rates would come down and someone would refinance into a 30-year fixed at a lower rate.
Right.
We've done that in the past. The challenge is right now, up until September of 2024, not to get too technical, but there is something what's called an inverted yield curve. And ultimately that means that in that case, that the short-term rates are actually higher than long-term rates And so the adjustable rate mortgage had no advantage. Now, the yield curve is no longer inverted, but just barely. So we are starting to see signs that the adjustable rate mortgages are going to probably here, in the near future, be an option for a borrower in order to have a reduction in their interest rate for the first few years of the loan and then look to fix it later. Part of it depends on how much they're putting down. A low down payment adjustable rate mortgage isn't going to be too advantageous for a borrower. But I think as the Fed continues to lower rates, which I still think they will do, probably my guess is 3 times this year, then as that comes down, we will start to see adjustable rates make more sense.
Fingers crossed. Yes. What is private mortgage insurance, PMI, and how can buyers avoid paying private mortgage insurance?
Yeah. So PMI is essentially to keep it simple, it's an added monthly fee. It's tacked onto the monthly payment, and it's in exchange for putting a lower down payment. So, you don't have to put a 20% down payment, but the trade-off for that is there's going to be this added monthly expense onto the mortgage payment called PMI, private mortgage insurance. And unfortunately, it's really there to protect the lender and not the borrower. So if the borrower make the payments anymore and they start defaulting on the loan, the mortgage insurance kicks in and protects the lender from taking a loss.
Yes.
Right. Now, you would think that, okay, well, of course, if you're explaining it to me that way, I want to avoid that. And there are ways to avoid that. There's a couple different ways, actually, depending on what someone qualifies for. But ultimately, one way would be to do what's called a lender paid mortgage insurance premium, where it's being built into the interest rate. So the interest rate's a little bit higher, but the monthly payment, the PMI monthly expense is gone. And so, the natural reaction is, well, why would I take a higher interest rate? It really depends on the cost of homeownership and how long you're going to be in that loan product. So there are times where it does make sense to take a little bit higher interest rate and not have the PMI, but you also have to factor how long you're going to be in the home, because the PMI can be removed too.
Right.
It's a matter of modeling it out and seeing which one makes the most sense.
Yeah.
And then it would be for someone to take a home equity line of credit.
Yeah.
And behind, so it's a first and second mortgage combination, so they don't have mortgage insurance. However, both of those examples of avoiding PMI ultimately are going to result in a higher interest rate on their mortgage. And so it is best, typically what we'll do in that case is we'll model out 3 different scenarios for the customer. We'll say, okay, here is your mortgage payment, and we'll break it all down, showing them how much is going towards the mortgage, how much is going towards PMI, et cetera. And then we'll do a second scenario with the lender paid mortgage insurance scenario. And then we'll do a third scenario with the first and second mortgage. So using the home equity line of credit.
That's
and
beautiful.
Explain all the differences. And, a lot of it has to do with someone's scenario and how long they're going to be in the home and what their plans are.
Exactly. So that mortgage consultation, and this is why it's so there's so many reasons why, getting pre-approved prior to going and touring homes is so important. And this is it right here, because, having a consultation with your realtor is one side of it, but then also having a consultation with your mortgage loan officer or mortgage consultant is the other side of it, because there's so many just back end questions to ask what would be better for the customer. So you getting to know them a little bit more, finding out those details, and then giving them the option so that they could decide which one is best for them. And I know back, when was it, before the crash, right? People were doing a lot of 80-20 loans. That was something that was...
I did one, yeah.
Yeah, that was something that was in play back then. And so do you see those nowadays though? Are those pretty common, or?
No, the highest they'll usually go is 80% on a first mortgage, 10% second mortgage, and then a 10% down payment. It'll be interesting to see if, it starts to come back higher than that. But once you go higher than that, then the rate starts getting really high. So I think that's probably in that loan structure, that's the sweet spot. Like you said, when you're consulting with both your agent and a loan officer, you really I think the best way to put it is you want to have a strategy, and you want to make sure that the team you're working with understands the strategy. Everyone's on the same page in communication about that strategy.
Exactly.
Because if you're not, then you can't execute that strategy properly.
Exactly. And there's different loan products which we're going to be getting into those questions as well too, but there's different loan products. Again, like Jason said, depending on what your goals are for this purchase, because also this is specifically about first-time home buyers, but a lot of first-time home buyers become investors, right? When they purchase properties in the future and things like that. So just definitely some things to keep in mind. How does a buyer's credit score impact their interest rate and their loan approval?
Yeah. So I think this one, is probably one of the most common that people talk about, and they have a pretty good idea of the general answer, which is, the better the credit score, ultimately, the better the interest rate. Now, I will say that, there are some loan programs like an FHA loan that is more forgiving with credit scores that aren't perfect. So you don't have to have an 800 credit score. You don't even have to have a 740 credit score. Really, I mean, even if you don't have a 700 credit score, you can still get a very good competitive interest rate with an FHA loan. So, again, part of assessing what options are available to the borrower and which one makes more sense is, looking at the credit score and then saying, okay, well, what loan programs, here's what it would look like with your credit score with an FHA loan or a conventional loan. Here's the difference in mortgage insurance. Here's the difference in interest rate, and modeling that all out and explaining the difference.
Exactly.
Yep.
Okay, perfect. And what is the difference between, okay, so this is a good one and this is one. This is something that definitely falls into what do I need to know that I don't know? A lot of these do, but here's one of them. What is the difference between being pre-qualified, pre-approved, and fully approved?
Yeah. So
Let's get into that one. Yeah.
Okay. So, the funny part about this is that if you ask this to several different, industry professionals, they may have a little bit of a different definition. To me, pre-qualification means that we're really just having a conversation and we're saying, okay, from a finance perspective, of course, we're talking about your goals, but pre-qualification meaning how much do you make?
Mhm.
What are your monthly expenses that show up on your credit report? What's your credit score? How much money do you have to put down? And we're really just using those answers to back into a conversation only, saying,
Right.
okay, well, based on what you just told me over the phone or whatever in a meeting, this is what I think you would qualify. It's that simple.
Yeah.
Pre-approval to me is, of course, having that conversation and getting idea of all the different, pieces of information we need from the borrower, but also then having them fill out an application, running their credit, looking at their income, collecting their W-2s and pay stubs, et cetera, asset statements, bank statements, investment accounts, whatever it may be, retirement accounts, and then calculating the numbers, but stopping right there. And that is a pre-approval. Why is it called pre-approval? Because that analysis is being done prior to the actual lender reviewing the financial information and saying, we're going to give this person a loan. So at that point, the challenge becomes everyone's doing this process of pre-approval, but the question becomes, how thorough was the pre-approval? There's pre-approvals that are done today that aren't collecting all the documents, aren't, for example, if someone has overtime or bonus or commission or their hours fluctuate, those things require a certain documentation to analyze in order to accurately calculate their income. And if that calculation is done loosely or inaccurately,
Yeah.
it'll jeopardize later on when they go into contract on a property, right? So
I've seen it happen and it's happened to me. Yes.
Yep. Right. And so ultimately, what we do is a full underwritten loan approval, which is essentially taking all the documents that I would normally collect for a pre-approval, and we're packaging them and sending them to the lender before a borrower goes out to a property and writes an offer. And at that point, now we have a fully underwritten approval from a lender. So it's not just about, okay, now we know exactly how much the customer qualifies for, of course.
Right.
But it's also now putting them in a stronger position where they no longer need to have a financing contingency within their contract when they write an offer. And obviously that puts them in a stronger position to negotiate with, whether it's they're competing against another buyer or they're competing against the seller on a better terms to buy the property.
Exactly. Because coming from a realtor's perspective, price is really important, right? Because I feel like sellers, they look at price, but something that's mislooked and overlooked is terms, because they really care about terms as well, too. So this is this is something, the number one reason why buyers cancel escrow is because they could not qualify for their loan because they're going through the pre-approval process. And that's like the minimum requirement to start looking and touring homes with an experienced realtor. You have to be pre-approved so that you know what your budget is. Because a lot of times you don't want to look at houses that are outside of your budget, even though technically you may be able to afford them. You may not want to spend that much on said house. So you want to just narrow down your budget. How does the loan to value, the LTV ratio, affect a buyer's ability to qualify for a loan?
Yeah, so I think what's important to understand, whether it's credit score or your down payment percentage, which ultimately is how this loan to value ratio is is calculated, right? So, loan to value, meaning your loan amount divided by the value of the home. So for example, you're buying, I'll just keep it simple, $100,000 purchase price, and you're putting down $5,000, 5%, then you're borrowing the other 95%. So there's a small down payment. The lender is taking a bigger risk. If the buyer cannot make the payment, then they have to take the property back. And when they have to take the property back, they have to resell it. And typically, they're going to want to resell it quickly to get their money back. When there's a little amount of equity in the property, it's a higher risk for them. So everything in mortgages is risk-based pricing. So two extreme examples would be, let's use a more realistic example, $500,000 purchase price, someone's putting $50,000 down, which is 10%. But, and let's say they have a 760 credit score. However, if someone's buying a $500,000 home and they're putting 50% down, with an 800 credit score, there's a lot less risk for the lender, primarily because they're putting a lot more money down in the down payment. So, and again, in the event that for some reason, if that homeowner can't make the payments, there's a lot of room there left in the equity for the lender to be protected and get their money back.
Gotcha. And I think that's a great kind of like roundup. It's just, it's the risk involved.
Yeah.
The risk involved. Okay, perfect. What are some key differences between conventional loans, FHA loans, and VA loans, and how should buyers choose?
Yeah. So ultimately, if you're a buyer that has the opportunity to use a VA loan, it's going to be hard to beat. I mean, let's just start with that. A VA loan is an amazing loan. So if you're active military or a veteran, there would have to be a very unique reason why it wouldn't make sense. Even if you had a large down payment, it would probably still make sense, maybe less, but it would still make a lot of sense to do a VA loan just because interest rates are fantastic. It does allow for a zero down payment.
Yeah.
There is no mortgage insurance. Is a very, very and well-deserved, of course, loan product, right? But for those of us that, didn't serve or don't have that option, the difference between conventional and FHA loans have really to do with interest rates and mortgage insurance from a numbers perspective to the, that's how you would see it. Now, there are guideline differences and nuances in regards to maybe if you're receiving child support or alimony or something unique like that. There are some guideline differences, but I would say the primary differences between conventional FHA would be conventional going to have a higher interest rate, but depending on your credit score, if your credit score is over 700, maybe 720, then the mortgage insurance will be cheaper with conventional. The debt to income ratio is going to be expanded, meaning it'll allow to go higher on an FHA loan. So an FHA loan, it's not for first time home. You don't have to be a first time home buyer to use FHA, but the reason it's often used by a first time home buyer is because typically a first time home buyer is maybe earlier on in their earning power of their employment in their job. And so, maybe, for example, we see it a lot. There are student loans and those extra payments add to their monthly debt. And so FHA is allowing for this higher debt to income ratio. So that, that would be a difference that I can think of. And then FHA has what's called an additional mortgage insurance that's added on to the loan called upfront mortgage insurance, right?
Upfront mortgage insurance. Yeah, it's an additional. Yeah.
Yeah. So it's really has a lot to do with the mortgage insurance differences and the interest rate.
Got it. That's a clear explanation. Thank you. How do you guide buyers to determine their true affordability range?
Yeah. So first of all, here's what we do. We collect all of their documents and we qualify them for the maximum that they can qualify for, right? But that doesn't mean that that's their comfort level in payment, right? So we do have clients who qualify for a much higher monthly payment than they want to pay. So the first thing we do is start at the high and then go down, right? So if someone qualifies for, a $7,000 monthly mortgage payment, but has no desire to be over $4,000 a month, we're asking that up front. We're not just asking about the technical nuances of how they're compensated and things of that nature, but we're also being mindful of, how much money do you have, but how much of that do you want to spend on a down payment?
Right.
Right. What's your monthly payment comfort level is one of the questions on our initial questionnaire, because we do want to be respectful of that. We don't want to put you in a situation where it's like you find the home that you love, but it's $2,000 more a month than you wanted to pay. We want to get all of that done up front.
Exactly.
right? So you have a full understanding. When Michelle goes to show you properties, you know what your payment's going to be, you know what the interest rates are, the closing costs, all the details.
Exactly. And it's never a situation of anyone trying to pressure a first-time home buyer or a buyer in general to pay more than what they really want to spend. We're really respectful with that, and we want to know what that is up front. So it's an enjoyable process for everybody.
Yeah, I think that.
Yeah.
And also, there's been times we've seen it where the comfort level, let's say again, is $3,500 a month, but then you show them properties. So let's say $3,500 a month equates to a $450,000 purchase price. And you show them $450,000 properties. But then they also see $475,000 properties.
Very good point. Yes.
Right. And then they come back, or we have already modeled that out.
That does happen. Yes.
Yeah. And it's $150 more. And like, well, okay, for $25,000 more in price, I can get a home that doesn't need any improvements done.
Yes.
Right.
Yes.
And it's only going to cost me $150 more a month.
Yeah.
So even though I'm a little bit above my comfort level,
you have wiggle room.
you're right.
Yeah.
Which is why we always start
Yeah.
at the highest amount and come down.
Exactly. I love that. What is the importance of being fully approved, and how does that help strengthen an offer? And I feel like this is a segue to the original question that we had asked to kind of define those three: pre-qualified, pre-approved, fully approved. But when we're fully approved, if we can dive into that a little bit more, because how does that help strengthen the offer? And I did feel like you touched on it a little bit, but is there anything more that does come to mind?
Well, I think the only thing that I didn't elaborate on is more of, so once you're fully approved, again, this is where the loan officer and agent working, as we've worked together for so long, it's not just getting it done, but it's executing it. So to get technical, the technical piece to execute it to the buyer's advantage is understanding the purchase contract. And so when you go through the contract with a buyer and you show them, okay, this is what contingencies are. Okay, contingencies are timeframes or milestones that both the seller and the buyer, primarily the buyer, have to meet certain deadlines. And so one of those is to get your loan approved. And so the average contract in California is what, a 14-day loan contingency.
Mm-hmm.
Right? And so what that means is this, is if a buyer were to put an offer on a property and just use the standard contract without modifying it, they have 14 days, 2 weeks to get their loan approved, and if they can't get approved, then they get the cancel and they can get their deposit back.
Yes.
However, when they're in a situation where they're competing against other buyers, the challenge becomes that oftentimes this transaction period is only 21 days long. It's only 3 weeks, or even 30 days.
Yeah.
And when you're a seller and you have multiple offers to choose from multiple buyers, which we've seen over the years happen.
Oh yeah. We're Southern California, San Gabriel Valley, Orange County. That's how our area is. Yep.
And when that happens, if I'm a seller, I'm like, okay, I have 5 different buyers that want to buy my property. Each buyer is saying, okay, the transaction period is going to be 30 days long on their offer. If we go 2 weeks, if I select one of the buyers and I choose them to be, okay, I'm going to sell my house to you, and we're 2 weeks into the transaction, and then your agent calls up my agent and says, I'm sorry, but John and Jane didn't qualify. I mean, imagine how devastating that is to the seller, because they're halfway through thinking their home is sold. They're making arrangements to maybe change school districts for their kids, or movers, utilities, all these things.
Right.
And now imagine the frustration. They've just lost 2 weeks.
Yeah.
Right. And then their property.
Go back to the drawing board.
Exactly. Right. And their property, now they put it back on the market and it looks like it's been sitting on the market, and what's wrong with the property.
Yeah.
So to give a buyer a more competitive advantage, again, that full approval will allow them, because they've done that prior to writing an offer on a property. So it will allow them to write an offer on a property and remove the loan contingency, but in confidence, protecting their deposit.
Right.
Because the lender has already issued an approval. So
already done the fully underwritten approval.
Right. So now when you're writing an offer on a property and you're comparing, if a seller is comparing your offer to these other pre-approved offers, essentially what you're saying in layman's terms is, do you want to take a chance with one of these pre-approved that hasn't been looked at by the lender? Or do you want to go with us that's already been vetted by the lender? This deal is going to close. This is just a matter of, can we come to an agreement on the terms?
And, there's appraisals, inspections and things like that. Like, there's so many moving parts.
Yeah.
Removing one of those mountains and those obstacles is going to just be, so, Jason and I, we pride ourselves on helping people save time, money and helping people make the process smooth. And this right here is one of the things that really shines for us working together as a team, because we help people make the process smooth. And this right here, Jason, this has been so helpful in helping my clients get their offers accepted. This has been huge, and making the process smooth at the same time. So applaud you and your company, for doing that. That really helps. Not all companies do that, by the way. It's a lot of upfront work. And
that's probably one of the number one questions we receive when we explain this, right? Is
yeah,
why does every lender it makes sense the way you're explaining it.
It's a lot of upfront work. And that's what Jason does. Yeah.
Do, right. And there's no cost for it, or you're
Mm-hmm.
not obligating yourself to anything.
Yeah.
It's a matter of us saying, as a team, what can we do that actually has true benefit for our clients that they can, that they can actually use in the marketplace that truly has value, not something like, oh, it's a slogan or a pitch. It's no, we're executing this and using it for them.
Exactly.
Right? But not obligating them to anything if they decide for whatever reason it doesn't make sense for them to buy.
Yeah. Exactly. So are there any opportunities for buyers in today's market, even with higher interest rates? Let's touch on that topic.
So that's probably one of the most important in this call, besides the full approval.
Right.
Yes. And what I don't like doing is being the guy that, I'm not one, when someone says, is it a good time to buy? I don't, it's not just, oh, yes, it's a good time to buy. What I mean is there is, but I really like to explain what that means, right?
Wow.
Because I don't want someone thinking, oh, I'm just trying to sell you on buying a home now, right? Super important to me, because I'm not pushy like that. I'm here whenever, I know we're both, whenever someone's ready, they're ready. When they're not, they're not.
I think that's why we work together, because we have this exact same vibe. There's no pressure.
It's not like that, right? So what do I mean by that? I mean that what you saw consistently when rates were ridiculously low in 2020 and 2021 was buyers outbidding one another. Not even sellers asking for more. This was buyers raising their hand saying, wait a minute, I'll pay $50,000 more. I'll pay $100,000 more. Of course, the seller is going to say, well, okay, if you want to give me $100,000 more, I'm going to take it.
Yes.
So, why is there an opportunity now? Because I would say that in the last 45 days, over 60% of the transactions we've closed have been structured in which the seller is not only maybe willing to come down on the price, depending on, again, Florida versus maybe Texas or California.
Area, location, exactly.
Location. Mm-hmm. But even in California, I have seen we have closed transactions where the seller is giving a credit to the buyer and the buyer is using that to reduce their interest rate.
Okay.
Right? So that is making the property more affordable for them. Now, that can be done in various ways, whether it's what's called a temporary interest rate buy down or permanently buying down the rate, which that would be a whole nother probably call to explain that. But at the end of the day, let's just keep it this simple. The answer to the question is, at this time on January 24th of 2025, there is an opportunity to negotiate. There was no opportunity to negotiate in 2020 and 2021. It was, look, how much are you going to pay me and how fast are you going to get this done? And that was it, right? I'm not saying it's a buyer's market. I'm not saying it's a seller's market. I'm saying it's more of a neutral market.
It's going into that for sure. Yeah.
Where there's an opportunity for the buyer to negotiate terms. Now, those terms might be the price. Those terms might be a concession or a credit from the seller to reduce the interest rate or cover the closing costs.
Right.
But nonetheless, there are opportunities 100% to have that dialogue between a buyer and a seller. And 3.5 years ago, that there was no opportunity. If you were even trying to do that, you weren't even getting a response from the seller.
Exactly.
Right?
Exactly.
Big difference.
Yeah, totally. That's huge. That's huge. What is the most common fear first-time homebuyers have, and how can we address that?
So I would say, in my experience, it's been just, there's a lot going on at once. It's exciting, but it's also, typically most people are going from a rent payment, maybe, or they're still living at home, so they don't have, or it's a housing expense right now, or they're going from a rent payment that is much lower. Let's face it, in most markets, especially in Southern California, no doubt, it is cheaper to rent.
Right.
Oftentimes, monthly basis, it's cheaper to rent today. However, the advantage to buying from that perspective means that when you're buying, you now have a fixed housing expense into the future.
Exactly.
Whereas rent keeps climbing, your 30-year fixed rate is not climbing. It's staying the same for 30 years.
Exactly.
So it's the fixed expense over time. That's one of the main benefits of buying. Obviously, there's others with tax deductions and appreciation, but
The equity, exactly.
right,
The equity.
right.
Yeah.
But it's the fixed expense. And so, I think the fear is if you approach as a buyer the situation of buying a home and you don't have everything lined up first, you're still, in the back of your head, well, can I afford this? How much is it going to be?
Yeah.
Am I wiping out my savings? And now my payment is, I was renting for $1,200 and now my payment's going to be $3,000. And, I had $50,000 in savings and now I'm going to have none. And, it's that whole thing in your head that you're talking to yourself, right? So how can you avoid that? Ultimately, I think it's more about preparing yourself. And so getting all of the documents into your lender, having a our second call with a customer is probably, especially a first-time buyer, is 45 minutes to an hour long minimum. Because that second call, the first one's more of a general overview and, usually a 15 to 20 minute call. But that second call is taking place after we've reviewed all of their documents and we are putting together an extremely detailed analysis of comparison of loan products and breaking down all of those things. How much money are they going to have to spend? What are the interest rates? What are the closing costs? What are their monthly payments? Right? Again, this goes back to your introduction about education, confidence, success.
Yeah.
Then educate yourself. And when you're ready, and obviously you rely on your agent and your loan officer to do that, right? That's what we're here for.
Right.
And then, just like anything, once you feel, you have more understanding of the process and you ask more questions and you get more feedback, then ultimately you're going to be, more successful. So we just happen to define success as not just buying a home, but buying a home and having a full understanding of what took place along the way.
Exactly. Another thing that I wanted to share from a realtor's perspective is the home warranty. So first-time home buyers, what you may not know is I help negotiate the seller give you a home warranty for 1 year, because what are some of the things that we appreciate from renting? We appreciate that we get to call the landlord or the property management company every time something fails. Like it could be the water heater, it could be the disposal. That is something that is a little bit of a perk for a renter because we don't really have to worry about those types of fixes, the big major appliances. And so when you purchase a home, everything is your responsibility. So that's maybe also an unexpected expense that maybe some people are thinking about, like I got to have a certain amount of money in reserves to make sure that I can, take care of that. And so one of the things that is going to be helpful is to get a home warranty. There's a laundry list of things that are covered: the water heater, the disposal, the dishwasher. You can add in the refrigerator. If the refrigerator goes out, what they'll do is they'll either fix it or they will replace it.
Yeah.
So, right. That's a big one.
I can speak from personal experience. Not only have we used our home warranty, but we renew it every year.
Yeah.
And I can tell you 100%, we've used it on our washer more than once. We've used it on the electrical board, on our oven, on our microwave, dishwasher, our fountains in our courtyard. I mean, my wife continues to add things to the home warranty every year.
And that's been a help, right? A big savings.
Right. Yeah. I mean, you figure, I think, to come out and repair something, I think it was like around $70, $80. So it's kind of like a deductible. But then you're talking about replacing an electrical board on a microwave or an oven that's going to be, or in our freezer, that was the ice maker.
Yes.
Right. I mean, you're talking about another $200, $300, $350, maybe $500 in some instances. So obviously I'd much rather pay just the deductible than spend another $500 to fix something.
100% air conditioning unit, HVAC. I mean, it's a laundry list. So that's something to look forward to as well. So Jason, everything that we talked about was so helpful and so informative. Anybody that's watching this, I would love to encourage you to communicate with us. Send us a comment on this video, and let us know, what are your questions? How can we help you? What are your experiences that you've had? We'd love to connect with you. Jason, do you have any final tips or words of advice for first-time home buyers navigating in today's market?
Yeah, I always tell all of our clients, but especially first-time buyers, I guess the one thing we haven't talked about too much is just ask as many questions as you can. I
Yeah.
always tell our clients that ask as many questions as you can, even if you feel like it's a topic that's already been discussed. It's okay because we obviously all interpret information in different ways. I
Yeah.
would say just ask as many questions as you can. That's what we're here for. That's what, your team that you're using should be doing. That one is one that comes to mind that is just a big one. Right?
Yeah, I agree. I totally agree. And I always tell people, it doesn't matter if you ask me once, twice,
Yeah.
3 times. Sometimes we just maybe life, right? Because people are so busy with work and kids and everything. They're like, did I ask you this? I don't know, but it didn't register. So we're very, very open in that way. So ask lots and lots of questions. And then, so what's the best way for a first-time home buyer to get started on their journey and connect with you? How can they best connect with you?
Yeah. So I think the best way is just to reach out, whether you want to give me a call or email me,
Okay.
right? We can do it that way. We'll usually set up an initial, introduction call, really answer any general questions that someone might have, talk to them a little bit about the process and how we handle it. It's really broken down into a 3-step basic process, and ultimately, figure out what their goals are and really just take it from there. And then, once we have their information, we do that second call that really, really starts to get into a detailed breakdown so they have a full understanding of everything that they're getting into.
Perfect. Perfect. I know you have a streamlined process, very organized, and that you go through with helping people. So you guys, if you want to get in touch with Jason, all of his contact information is below in the description. Thank you so much, Jason. Thank you so much for doing this and for, informing everybody out here. This year, you guys, is going to be a great year. If purchasing a home is something that is on your goals list for 2025, or even a little bit down the road, and you just want to talk to us to pick our brains, we are here for you and we would love to help you. Thanks again. Bye.